Question 61, call options are primarily purchased by investors who are A, bullish, B, bearish, or C, risk averse. So if we're buying call options, we will benefit when the market increases. When we think the market is going to increase, that means that we are bullish. Bearish would be the opposite. We would be buying puts or selling calls, and then risk averse would probably kind of fall under the same scenario. We'd be more likely to kind of be invested in less risky assets than call options. Answer A. Question 62. A 3-month call option with an exercise price of 38 is being sold for $6.50. The underlying is currently worth 42 and the risk-free rate is 3%. Assuming put call parity holds, a put option is being sold for. So let's pull in our put call parity formula and we will work through that. So our formula is the value of the call option, which is going to be that 650 number, and then our X divided by 1 plus R to the T. This is going to be our the exercise price is what the X is going to be, and that's going to be discounted backwards to give us our risk-free bond. And then that's going to equal the underlying current price plus the put option. So the put option is what we want to solve for. So what we'll do is we'll move the strike price or the underlying over here, and then we can plug in all our numbers and get our answer. So we end up getting the put equals 6.5, which is the call, and then we get 38 for exercise divided by 1.03. For our R to the T, we use 0.25 since we have a 3-month call option, and that's 1/4 of the year. And then at the end, we subtract the underlying, which we have at 42, gives us a put price of 2.22. Answer A. Question 63. An investor that enters into a long equity forward contract on a total return stock index will be concerned about the management of price risk, the uncertainty of dividends, or C, both price risk and uncertainty of dividends. So key here is going to be total return of the stock index. That means we're including price and we're including dividends in the return of that. So we will go with answer C. We need to concern ourselves with both the price risk and the uncertainty of dividends. If it were a price return, if it were the price return on the stock index, then we wouldn't need to worry about the dividend portion. But in this case, we do. Answer C. Question 64. A long-term European put option will always be worth more than an otherwise identical short-term put option if. So the key here is long-term European puts are going to be more sensitive to kind of the inputs than a short-term put option will be, and that's due to kind of the longer duration nature of them. So factors in here that make put options go lower or higher in price are going to be more pronounced in long-term puts than in short-term puts, which can kind of lead to those price dislocations. So A, volatility is lower. So when volatility is elevated, European longer-term puts are always going to be worth more because higher vol is going to lead to a higher price. And when we're longer term, we have more kind of sensitivity to that. However, if volatility is lower, it may not always lead to being worth more than the short-term put. So we can rule out A since it might not always be more. B, interest rates are lower. So when interest rates are lower, this is going to be a positive for European puts. So low interest rates is going to lead to put options increasing. And so kind of the opposite of what we said in A. So because we have more sensitivity here, when those interest rates are lower, this is going to lead to those longer term puts to increase more than the shorter term puts. So B is looking like it'll probably be our answer. And then C is just the opposite of B. When interest rates are higher, this is going to be a negative for put values. So it could lead to the more sensitive long-term put falling below short-term put. Answer B. Question 65. Carlson Smith has invested in an FD hedge fund with $450 million under management. The fund charges a 2% management fee based on the funds under management at year end. A 20% incentive fee calculated net of management fee is earned over a 6% hurdle rate. FD hedge fund appreciated by 10% over the course of the year. Smith's net of fees return is closest to. All right, so let's pull this in and start walking through the calculations in order here. So our management fee, we're going to want to calculate first, and it charges 2% based on the value at year end. So we're going to take our 10% return, multiply that by our beginning value to get that end of year value, and then our management fee, we're going to calculate it based on that. So we get 9.9 for that management fee. Our incentive fee is net of the management fee. So we're going to subtract out the management fee from our calculation. And then we also need to subtract out that 6% hurdle rate. So 6% hurdle rate is going to be the 450 times that 6%. So our incentive fee is only on profits. So first thing we subtract out is just the difference in AUM. So our profits is 45 million. And then we subtract out that management fee, and then subtract out the hurdle fee, and then multiply that by the incentive amount, which is 0.2%. So we get 1.62. And then our net of fee return is basically going to be ending AUM minus management fees minus incentive fees, and then divide that by starting value minus 1 to get the percentage, which is 0.0744, corresponds right here to answer A. Question 66. A desirable characteristic of alternative investments is most likely. A, liquidity. We're going to rule that out. It's not necessarily a desirable characteristic. The liquidity of alternatives tends to be not great, especially if you're in something like private equity. You're going to be locked up for 5-10 years or more. So the liquidity there is not desirable. B, transparency. This is also not going to be our answer. Alternative investments are generally more opaque due to lack of regulation, and that's because it's really only available to accredited investors, and that's why they kind of allow that opaqueness. So they're not transparent. And then C, low correlation with traditional investments. Yes, this is typically one of the main reasons that institutions and high net worth individuals want these assets. Answer C. Question 67. Which of the following is least likely a valid reason for investing in real estate? So 2 of these are going to be good reasons for investing in real estate, and 1 is not, which will be our answer for least likely. A, inflation hedging potential. We can rule that out since real estate is often found to be a good inflation hedge along with other real assets. As prices go up, those real assets also tend to go up. B, likelihood of diversification benefits. We can also probably cross this off since this is typically a reason for investing in real estate. Especially private real estate, it tends to be a lot less have a lot lower correlation relative to traditional stocks and bonds. C, limited involvement in operational management of properties. That is that will be our answer since there is going to be a lot more involvement. And, you can always hire a property manager or work with a fund that is going to do that. But somebody's going to have to do it. So you're either going to have to pay for it or do it yourself. And even if you're paying for it, you're still going to likely have some level of kind of decision making or involvement needed there. So go see. Question 68. An analyst gathered the following information regarding a fund. Total shares outstanding, 500,000, assets, 1 million, liabilities, 300,000. The NAV of the fund is closest to. This is going to be a pretty straightforward calculation. Our NAV is going to be assets minus liabilities, which we're given. And then, a little typo there, let me fix that. And then we're just going to divide that by the shares outstanding. So we've got 1 million minus 300,000 divided by 500,000 gives us 1.4, which is going to be the per share value. Answer B. Question 69. Brian Ross is a wealthy entrepreneur managing his own investment portfolio. He is seeking to expand his investment portfolio, which comprises solely of equities. Ross is seeking a tax-efficient investment, which has a moderate to high degree of liquidity and can bring diversification benefits to his portfolio. He is exploring direct real estate as a potential investment vehicle. Which of the following factors could most likely discourage Ross from investing in direct real estate? So he wants something that's tax efficient, moderate to high degree of liquidity, and can bring diversification benefits to his portfolio. So why would he not invest in real estate if those are his goals? So we've got A, illiquidity. The liquidity of real estate could certainly discourage him. It takes a lot of time if we want to sell a property, which is what is implied by direct real estate. He's going to be buying and selling the properties himself, which takes time. It takes time to get the property ready to sell. It takes time to get it on the market and actually sell it and close and all that good stuff. So this could certainly discourage him. Let's look at B and C and make sure we can rule those out. B, tax consequences. Real estate is generally considered to be very tax efficient due to the depreciation benefits and other deductions that they'll have associated with kind of the management of those properties. And then C, low diversification potential. Typically, he's going to have pretty good diversification relative to just equities. So we'll stick with A, illiquidity. Question 70. At the beginning of the year 2012, Gus Knight invested $100,000 in a hedge fund with a 1 in 10 fee structure. The fund's value at the end of the year rose to $135,150 and 5% by the end of 2013. Management and incentive fees were paid at the end of the year, and the incentive fee is calculated net of management fee. That's always important. In the year a fund's net value declined, incentive fees would not be paid. The hedge fund's high water mark at the end of 2012 is closest to. Alrighty, so the high water mark is basically, like it says, incentive fees are not paid above that high water mark. So let's pull that in and we can talk through this. So our gross return for 2012 is just going to be that starting value or ending value minus that starting value, which gives us $35,150. Our management fee of 1% is on that end of year value of $135,150. And then our incentive fee is 10% of profit after the management fee. So our profit after the management fee is $35,000, which is our profit from up here. And then we subtract out that management fee, which is $33,798, and then we're multiplying that by our 10%, which is implied by the 1 in 10. So when it says 1 in 10, it's 1% management, 10% incentive. So our incentive fee comes out to almost $3,400. So our net value after all fees for 2012, this becomes our high watermark since it's high watermark after fees. So we take that ending value, subtract out all the fees that have been collected so far, and we get to $130,418, which is going to be that high watermark number. So essentially what this means is if the fund, this is the NAV of the fund right now, if we decline back down to 100,000, the fund manager has to get the fund above 130,418 again before they can start collecting that 10%. Answer A.